Uh, Now I want to talk about, we have seen that what is the market trend in the issuance of Sukuk, and still, although the market is affected by the financial crisis, but there is a big potential to grow, and the market has not suffered a lot as compared to what we have seen in the conventional issuance, and it is likely that as soon as uh, little confidence is back in the market, more Sukuk issuance will be there, and this product will catch on very quickly. After looking at the market trends, I would like just to come to what are the Sukuk and how do they work. Most of you may be familiar with the basic structure of the Sukuk. I will just quickly go over them. The government Sukuk financing, how Sukuk can be used for government financing. Here is the government, its Treasury Department, a special purpose vehicle, banks and financial institutions and investors. Government, either directly or through the use of Treasury, can create special purpose vehicle which will issue Sukuk on behalf of the government, which will be marketed to the banks and financial institutions, or it can be marketed directly to the individual investors. And if the government is issuing Sukuk directly, it can be used for fiscal expenditures. If the government, if the government uses Treasury and uses the central bank to issue Sukuk through banks and financial institutions, then those Sukuk can also be used, that kind of Sukuk which are issued by the central bank can also be used as a monetary policy device. But this is an idea which requires a large amount of Sukuk issuance which can be used to create a sort of open market operations in the market. The government could have, or any entity which wants to raise money from the market can directly issue its own shares, it can directly issue its Sukuk. But why the use of special purpose vehicle? Why usually the corporate sector, in the case of issuance of Sukuk, they take the route of using a special purpose vehicle or special purpose entity or special purpose company? Basically, there are three reasons for it, three functions that the SPV will provide. One is that bankruptcy remoteness. It creates a bankruptcy remote entity, because think of a company A, which has 5 different businesses. Some of those businesses are profitable, some of those businesses are not that profitable. If that company A is issuing its shares or its Sukuk, people will judge the overall company at its overall level, because money raised from one entity can be used to subsidize the other branches or other businesses of the same company. The assets can be transferred from one entity to the other entity within the same company, and if one entity or one section of the same company or one business of the one holding company gets bankrupt, then it will be its other healthy units will also be affected. But if you are separating your entity, if you transfer your assets of a good company or a good unit to a special purpose vehicle, and that special purpose vehicle then issues Sukuk against those specific assets, then you are creating a layer which will protect the investors from the bankruptcy of the original company. That original company, because it was operating into 5 different businesses, one business is affected, then all other businesses are affected. This is one kind of, or one nature of one way in which the bankruptcy can come in. But if you separate the assets of the successful business subsidiary and transfer it to an SPV, then your investors exposure is only limited to those assets which are good and which are in the custody of the SPV, and hence it is a bankruptcy remote vehicle. It creates a distance from the bankruptcy of the original company. Another reason why SPV is created is to form a trust or to create a different ownership of assets who can hold these things as a trust. SPV is also created to facilitate the issuance of the Sukuk. So benefit or the main purpose of an SPV is investor protection and credit enhancement of assets, because you are separating and segregating the assets against which the Sukuk are issued. Not all assets are covered by the Sukuk, but only specific assets. So it creates a credit enhancement, and in this way it also protects investors. But do we really need an SPV to the investors? Many investors. The price that is received by the sale of these Sukuk is used to pay the originator the price of this asset that has been transferred to the SPV. Now the asset belongs to SPV. SPV has issued Sukuk against those assets. So de facto investors are the owners of that asset, but investors' rights are different, that they don't have a voting right in that, they don't have other right to use the asset, but they have the right to benefit from the asset, from its proceeds as well as capital gains, whatever. Now there is a second contract in which the originator takes the asset on the lease basis. That asset is being used by the originator, and the originator is paying periodic rents which are passed through by the SPV to the investors, who are the Sukuk holders. So this is the basic structure of Ijara Sukuk, which was called, the proponents of idea were Munzir Kahf and others, who called this asset Ijara bond. And the idea also was reflected in the International Islamic University's publication IIIE Blueprint of Islamic Finance that came in 2000, much before the Ijara Sukuk came into being, when they called it asset Ijara bond, that some government is issuing, government for example needs a firing range, to develop a firing range for training of its soldiers. This firing range is not a revenue generating activity, it will not generate any revenue, but nevertheless this is important for the defense of the country, to train the soldiers. How the government would finance it? One possibility is to issue Sukuk against a piece of land which will be developed into a firing practice range for the soldiers, which is not revenue generating, but the government will raise the money from the public through issuance of Sukuk, develop the firing range for the practice of the soldiers, and will pay a periodic rent to the investors through its other sources of income. Now the field is developed and the public service is provided. What will happen to that field? Suppose the contract was for 10 years. After 10 years, when the training is over and the use of that firing range or that defense purpose thing is over, that barren land is situated in a remote area where there is no use of that land. It may be just a hill without anything. So what the investors are now, the Sukuk holders are now in the possession of that. What they will do with that? This was the question. Because there is no use value and there are hundreds of such investors, and there is no specific piece of land that this 100 yards belong to Mr. A, this another 100 yards belong to Mr. B. This is not the case. So this was hindering the marketability. What the practitioners came up with this red line, that providing a put option with the investors to exchange of asset at an existing at an exercise price, that the originator, if the originator promises that at the end of the lease term he stands to buy that particular property or that particular asset at such a price if the investors are willing to sell. This unilateral promise closes the deal and it makes it more attractive and a marketable asset in the market. This is the structure of a generic ijara sukuk. If you combine both, if you make it mutually binding, two promises, then it becomes a sale in which is prohibited. So how the genuine ijara sukuk structures are made is that there is one unilateral promise, either a put option with the investors or a call option with the originator, one-sided promise to buy. In case the value of the asset is, think of a put option where the investors have the right to sell to the originator. If the value of that asset at the end of the lease term is very minimal, they will not exercise the put option. If the market value of that asset is higher, then they will exercise. If the market value of that put option is higher, then they will exercise the put option. If the market value of that asset is lower, then the investors will not exercise. So this is not eliminating the uncertainty completely. It is not removing the risk completely, but nevertheless making it attractive. If you compare sukuk with the bond or the conventional securitization, we can see various features which distinguish a ijara sukuk or a sukuk from conventional bonds. Sukuk are different from traditional conventional financial instruments. For example, sukuk represents ownership of assets or business or project for a fixed time period, whereas bonds are tradable debt obligations for fixed time period. Stocks are perpetual ownership of shares in business with control rights, whereas sukuk are not perpetual ownership, they are limited time ownership with no control rights. If we compare them with the derivatives, derivatives are based on rights and claims on other assets. They may not have their intrinsic value, but in case of sukuk, they have intrinsic value. Sukuk are different from conventional securitization also. In case of sukuk, investment sukuk as defined by Yofi are certificates of equal value representing undivided shares in the ownership of tangible assets, usufruct and services. Whereas in conventional securitization, securitization generally relates to the converting of loans of various sorts into marketable securities by packaging loans into the pools and then selling shares of ownership in that pool. Similarly, in case of sukuk, receivables cannot be securitized to convert them into tradable instruments because they are not tangible assets which are tradable. You can convert them into sukuk kind of thing, but those sukuk will not be tradable in the market. There won't be any secondary market for that. Whereas in conventional securitization, receivables can be securitized. There are various types of sukuk and there are various ways to classify them. One method of classification is based on underlying contracts of the sukuk. Another method can be on the nature of the underlying asset that the sukuk has. Suppose we go by the first classification by the underlying contracts. Then based on that underlying contracts, Yofi has defined 14 types of sukuk, which can be broadly classified into 4 different categories that are asset based, that is either ijara on the existing owned assets or existing lease assets, existing future assets, and the future assets as well, ijara on future assets, and manfa'a or benefit, that existing and future usufruct which is available. The underlying asset can be, the type of contract can be debt based. It is if the sukuk are issued against a pool of istisna, salam, murabaha contract, then this is another kind of debt based sukuk which will not be tradable in the market. You can only issue it, and a large chunk of istisna and salam and murabaha contracts you can securitize them into and creating many large number of claimants of a small amount. Diversification benefit you can get, but you will not be able to create a secondary market or tradable instruments in there. Based on underlying contract, sukuk can be classified as equity based sukuk, which includes murabaha, musharaka, muzara, musaqat, muwarasa, etc., etc. And this is not murabaha, but it is mutaraba. It is mistake over here. Similarly, Agency based sukuk can also be created based on wakala, that I will do something. An agency is providing the service, and against that service sukuk have been issued. The other way to classify sukuk is based on the nature of underlying assets, whether it is project specific or asset specific or balance sheet specific. Example of project specific is that to be constructed project, that is a future asset, you can create a sukuk on that. Asset specific, you already have an asset, you have securitized it. Balance sheet specific is you have pool of real and monetary assets on your balance sheet. In any case of bank like IDB or any other commercial bank as well, which can be securitized provided that the pool creates more of the real assets as compared to the monetary assets. I talked about the Ijara sukuk, but there are other alternative structures that have also evolved over time. This slide shows the 14 types of IOF sukuk that have come up. I will discuss only two types of other sukuk. One is the Sisna based Ijara sukuk, that is construct and lease. That the asset that we are leasing, on which against which we are issuing sukuk, is not present at the moment when the sukuk are issued. Example is of the Rat sukuk, the Rat and Rakhil, that the Rat company in Bahrain wanted to create a real estate buildings and residential complex, which will then be leased out, and that rental will be used to pay to the sukuk holders. So SPV, the Ra Sukuk company, issued sukuk when there were no buildings or no property yet available. The proceeds of that sale was used by the Rat Khalij company to construct the house, construct those real estate companies. For that purpose, istisna contract was given to the contractors. Istisna payment, upfront payment was made using the money from the sukuk holders. When the buildings were completed, they were transferred to the SPV. SPV then rented it out to the Zarat Khalij company, who was paying periodic rent, which are passed through to the sukuk holders. This process took some time, for example 2 years, 3 years time, before the buildings are constructed and before they are occupied by the tenants, which will generate the rental revenue for the sukuk holders. What the sukuk holders should do in between, in the interim period, for that purpose, another device was used, that not all money was given to the contractors. It was a gradual istisna contract or periodic istisna contract. Rest of the money was invested in the other investment opportunities, and the returns that were generated from that side investment during the interim period was passed on to the sukuk holders. So this is how on mudaraba basis, or there are two ways, either on mudaraba basis or you pay them the advance rent that you balance later on, because you are paying them advance rent that you will adjust when you actually. That is one of the conditions in the Ijara contract, that suppose I don't have, suppose I have a house which I am renting you. You will be moving in on December 31st, you will be moving there, but it is 6 months from now to December.